Welcome to the Real Estate Forum, a podcast from the Paul Milstein Center for Real Estate at Columbia Business School. I'm your host, Raphael Sidelsky. This is your place for key insights into the evolving real estate landscape, from candid conversations with real estate thought leaders, including the esteemed faculty of the MBA Real Estate program, to cutting-edge research from the Milstein Center's Research Lab. Let's dive in. My guest today is Anar Chudgar, the co-president of Artemis Real Estate Partners. Artemis is a U.S. real estate investment manager based in the Washington, D.C. metro area with offices in New York, Los Angeles, and Atlanta. The firm has raised over $12 billion of capital across core plus, value add, and opportunistic strategies, and makes equity and debt investments in a broad range of sectors. Anar brings more than 20 years of experience across real estate principal investing and investment banking. She currently serves as chair of the board of the directors of the Pension Real Estate Association and is a global governing trustee of the Urban Land Institute. Anar, welcome to the show.
Thank you so much, Raphael, and I really appreciate you guys having me on. I'm excited about our conversation today.
Well, likewise. You had anything but a traditional Wall Street roadmap growing up, and you've spoken about how leaning into hard things helped you along the way. Walk us through your origin story and how that mindset propelled you to Wall Street.
Yeah, it's funny. So I grew up in Pelham, Alabama, and my parents are Indian immigrants. And, my father's job kind of relocated him to Alabama. And, I did not grow up with a Wall Street roadmap in front of me. Now, as I look back in hindsight, I kind of happened into the career, but there were a few fundamental things that really grounded me as a child. And my parents were entrepreneurs. And, when they left India in the 70s, they were looking for better education and, were willing to work hard to get ahead. And I think watching them made me acutely aware of how others perceive me. And I was always determined to, succeed or outwork everyone around me. And so for me, it was just second nature watching my parents. But I started my career in investment banking and really happened into the real estate group. It really had to convince me to go into real estate. I had taken a few courses at the University of Pennsylvania, Wharton School, but I really didn't major in real estate. But it really was that investment banking program at JP Morgan that really introduced me to real estate and the tangible nature of the asset class, which I really gravitated to and I really, loved. I moved on into principal investing after my experience at JP Morgan, and then worked at firms like iStar Financial, Onyx Corp, Credit Suisse, and then really when I joined Credit Suisse was really after the financial crisis, and it was the acquisition of our team from Credit Suisse, from Credit Suisse to Grosvenor, where I co-led the creation of the real estate team and helped grow that team and business into a $9 billion platform that it is today. So that's really the roadmap or trajectory, but it really was not traditional.
What are the lessons you took away from your investment banking experience that helped you in that transition to private equity at Grosvenor?
Yeah. So after investment banking, I went straight to the buy side. So it was 2 years in investment banking and then went into the buy side. And like everyone else was trying to figure out how to invest. And so for me, it wasn't just that investment banking that led me into private equity. I knew that I wanted to learn how to invest and how did I do that? It really took a few firms for me to really get it right. And it was more, it was the firm's training as well as 2 decades of experience and multiple market cycles that I really learned the most. And it was willingness to do complexity, take on complexity. So what does that mean? It means that it wasn't necessarily taking the traditional path of always staying on the acquisition side or taking roles that weren't the obvious next step. I really measured my success by the people I worked with, the platforms that I was building, and the value creation that I was creating for those individual organizations, not really by job title alone.
And you had a very successful run building the real estate platform at GCM Grosvenor. What drew you to Artemis And what did you see there that made it the right next step in your career trajectory?
Yeah. And I think for me, I wasn't really looking for a next step. And it really took to one of our largest investors, a Grosvenor, came to me and said, "Hey, you're too comfortable." And I was really astounded by that message. And I really took me that moment. I had been at Grosvenor at that point, 9 years, and really built this amazing business. And I realized that I wanted to continue to challenge myself. I also wanted to go to a firm where I could create a lot of value. And for me, Artemis was founded by two extraordinary women, Debbie Harmon and Penny Pritzker. And from day one, the culture has always been about alignment, humility, and partnership. And so for me, I had actually a lot of opportunities in front of me, and I really wasn't necessarily looking for that next opportunity. But really, what made me gravitate to Artemis was, after spending decades as the only female and minority in the room, I was drawn to Artemis because it was built differently from the ground up. And I noticed very quickly that there was a really value to diversity of thought and perspective. And I really thought that my voice could create value for the firm. And so that was really what ultimately drew me to the organization.
Tell us about Artemis today. How is the platform structured? What are the different fund vehicles you operate? And where does the firm fit into the broader real estate landscape?
Yeah. So today, Artemis is 12 billion of equity under management. We have 21 vehicles. And those vehicles comprise of our value fund series, which was our first vehicle and our flagship vehicle, our core and core plus fund series, numerous separate accounts, our healthcare fund series, which was started over a decade ago, and separate accounts in debt and equity. Today, we purchased over 390 investments. We've sold more than half, which I think is really differentiated in the market. We have over 100 plus investors, mostly institutional investors. And we really started Artemis to be, the best in class middle market capital provider of choice across the risk spectrum and across the capital stack. And through that, we built an emerging manager platform dedicated to generating, attractive risk adjusted returns for our investors, but also being in a space where we felt there's less capital. And so we start our EM program at Artemis is currently totals over 15 billion of gross purchase price of assets with over $7 billion of committed equity. And that's over 100 plus emerging manager operating partners. And we realize, a significant majority of that was over, that's generated a outsized target return. And the proof of that, I think, which is the most impactful statistic that I'm pleased to talk about, is that we've paid over $500 million in promote and fees to these emerging manager operating partners. And as we look across the industry, we don't feel that any other program in the market has delivered this level of economic impact. And the measure of the success of our impacts actually through the outcomes we've delivered over the past 16 years. So many of our operating partners or emerging manager partners realize that significant outperformance. They're then taking it back to their micro location or economy or business. And then that is, really changing the ecosystem. And, that has really been to the benefit of our investor base. And not only are we showing that you can do well by investing in, a diverse group of emerging manager operating partners across the country in the middle market, but we're now seeing 19 of our EM partners themselves have graduated past just working with us and directly to our institutional capital partners themselves. So we really look at the ultimate success of the program through that economic impact, as well as our partners accessing institutional capital on their own.
So how much of your edge do you think is structural, your middle market focus, your sort of adoption of this emerging manager program earlier than others, your use of local operating partners, and your ability to invest across equity and debt versus, cultural or judgment driven? How do you think about those different elements in formulating your success?
Yeah, I think it goes hand in hand. I think inherently judgment is going to, as you see with the change in the industry, and just the changing of asset classes, changing of capital markets. I do think multi-decade and cyclical experience does matter, but I do think it looks at our holistic approach. So each leg of the chair is critical to our overall success. So not one thing. I wouldn't just triangulate it to cultural or judgment. I think it's holistic. And we've witnessed other firms who only invest in one asset class or one type of investing really invest over a cliff, as we say internally. And so for us, it's really this judgment and culture combined, which equates to pivotability. And we literally do think that has been the key to our success. So what does that mean? It means that we're identifying the best risk-adjusted returns at any point in the cycle, and we're able to invest across the capital stack. So we see where is it better to invest in credit versus equity, or maybe it's pref equity or structured equity, and across geographies and product types. As we've seen just in the past several years, where the darling asset class has quickly gone out of favor or value has diminished quite significantly, being able to pivot is really important. And I think also it's our resiliency in our organization, and that started at the beginning. And what I mean by that is we were early to start. So over 15 years ago, we had co's at every level. So we have co-portfolio managers, co-presidents, co-CEOs, and that is intentionally thinking about apprenticeship. We're in an apprenticeship business. And so we're always kind of learning from each other, but also creating that intentional succession planning and not depending on one person. And that really does allow our senior people that if we did have turnover, it wouldn't materially damage or impact the future of the firm. It also creates opportunity for our team and opens doors for the next generation.
Recently, Artemis joined forces with Barings. How did that partnership come about, and how does that fit into the evolution of the platform?
Yeah, I think we always intentionally knew that if we were successful, we would want to have our culture, our approach at scale. It's not lost on us that we see more and more investors doing more with fewer. And our senior team is always planned with succession and sustainability in mind. And the perpetuation of Artemis's culture has always been at the forefront of our goals since inception. So our partnership with MassMutual and Barings was a natural evolution. We had a limited balance sheet, and for the amount of amazing growth that we've been able to benefit from, we really knew we needed a larger balance sheet and a creative capital partner. And I think, as we thought about the right partner, we went back to MassMutual and Barings, where, going back to our predecessor firm, where a lot of the team came from, they were an investor. MassMutual was an investor in JER's first fund that was raised in 1996. So there was this beautiful symbiotic and synergistic partnership that came about with this investor who knew us even back to the predecessor organization and had seen the trajectory of our senior team, for multiple decades. And so for us, that was really very, perfect partnership. And not to mention the fact that they're a large organization with a lot of capital and from different pockets of capital. So
has this partnership changed the types of opportunities you pursue, or is the strategy the same strategy, but now bigger balance sheet, more flexibility?
I would say bigger balance sheet, more flexibility. I don't think that it's really going to change how we invest. We, again, want to keep to the DNA of Artemis and our culture, but we've already found the benefits of scale, whether it's in infrastructure, bringing our teams closer together, and excited to leverage, Barings' vast distribution capabilities, as well as bring offerings to a global client base, because our client base historically has been more domestic, which we feel like we wouldn't have been able to access on our own. But everyone we met from Barings and Artemis, from the Barings and MassMutual teams, have been extremely collaborative, and I had high expectations for our partnership. And we believe this is the recipe for long-term success.
If you look back, which are the strategies or sectors that have delivered the most consistent investment returns for Artemis?
So I wouldn't say strategies or sectors, because again, I talked earlier about pivotability. So, it's our approach to be able to pivot across the asset classes have really rewarded us over time. If I look back to 18, 19, we really didn't invest a ton in office. That really helped us through COVID, right? We had a few deals, but not a tremendous amount. And it was really the acknowledgement of understanding, okay, having the expertise to having invested in asset classes, before interest rates were zero for a period of time, really going for me personally, going through that GFC experience really did impact us to understand positive leverage versus negative leverage, really trying to understand, you can't always invest with one perspective. And so I really do believe that it is our pivotability that has been able to generate our performance or outperformance over time. And so I wouldn't say it's a consistency on asset class or sectors, but it's more about really recognizing that risk reward. And you see that through our investor base re-up. We have a 95% re-up rate, which is something we're very proud of. And we really recognized early in the 2000s that there was a gap in the market, whether in healthcare or real estate investing. That's the same gap that we recognize in the EM space, as I spoke about earlier. So for our general theme is trying to find where capital isn't and develop an expertise in that space. So as I look to our success in healthcare, it's really about the fact that we've been in the space for a long period of time. We're not a shortest investor in the space. We've evolved our strategy over time. Healthcare real estate is not for the faint of heart. It really does require a lot more oversight and a really dedicated team. So we actually have what we call our specialized asset management team, which is actually has individuals, a group of executives that have come from operators, senior housing operators, that sit on top of the operators we work with. And we really do feel that is differentiate our expertise in the market, but it really has changed the trajectory of our performance. We are we take an alpha driven approach. And that's you'll see in our performance over time. And also on top of that, the fact that we, team up senior housing with medical outpatient investing from a healthcare tailwinds perspective was done very purposeful. And that was because we looked at it and said, okay, the alpha's really coming from the senior housing, but the medical outpatient really generates really thoughtful cash flow. And the joint of the two strategies really is complementary to each other, and therefore can create a nice holistic solution for investors who really want to benefit from the healthcare spending that's occurred in the US and the continued growth of healthcare spending that's occurring. So we really do believe that differentiation, that combination is what differentiated not only our performance historically, but the traction it's getting in the market.
Now that the first of the baby boomers are turning 80 this year, there's this powerful secular demand wave, but senior housing remains a sort of a complicated, operational intensive business with much lower margins than other real estate asset classes. So where is your sort of focus in the area? Is it age restricted? Is it assisted living? Is it skilled nursing? It is a combination. Where do you think you're going to be playing in the next several years in the senior space?
So yeah, we typically invest in assets across the continuum of care. That's traditionally where we've had the most success. We really do not focus on assets where there's any kind of government assistance. Our focus is on investments that are private pay holistically. As I mentioned earlier, we have developed that operational expertise. And the way we think about this asset class specific is that it's one part operations and one part real estate. And therefore, we really do try to triangulate the risk of the business plan. But so we're looking at the upfront underwriting. We understand there's real difference in operators. And so I think it's important the scrutiny of the operators, the fact that we've worked with numerous operators over the past decade just within Artemis and have the experience of what's the right recipe to make the right operator relationship with us as the capital partner, but as well as having that specialized asset management on oversight. Because as you think about from senior housing specifically, the challenge on reputational damage can happen very quickly. So we believe that healthcare is one of the most, attractive opportunities in the broader real estate market today. However, you really need to do it with someone who has had the, 2 decades experience and really understands the sensitivities, whether it's regional operators or national and our approach has always been to focus on that regional operator who are local to that market. Because as we look across market by market across the country, you realize it's very specific in a localized business. And it's really hard to take that nationalistic approach to the space.
Where else is Artemis focused now in terms of sectors and geographies?
So we are, we like to say we're asset class agnostic, but we have developed a significant expertise into the alternatives. It wasn't purposeful; it was by nature. But from 2010, we started investing in storage before people called niche asset classes, and alternatives were a thing. So we've seen a lot of institutionalization in the alternative space. But I do think that what people fail to recognize is the operational intensity of some of these asset classes, whether it's storage, whether it's manufactured housing, student housing. There are fundamental shifts that are occurring even within these niche sectors. But a lot of these niche sectors are, small equity checks. And so there are inherently aggregation strategies for these asset classes to become institutional. So for us, as I said earlier, we're always willing to do the work. So we look at it agnostic of, small equity checks or large equity checks or institutionalization or not. We really look at the fundamentals and our, bottoms up investors. So from a sector's perspective, we are still focusing on, have a significant push into the alternatives or niche asset classes.
When you look at the public markets today with residential and office trading at discounts to NAV, who do you think has it right, the public markets or the private market players?
Yeah, I would say neither, because if it's depending on the asset class, if you look at office REITs, office is trading at a discount to NAV for the past 8 years. If you look at resi in general in the public markets, it's actually kind of quite interesting where what the resi REITs are trading versus private valuation. And there could be an arbitrage there. But healthcare is quite opposite. If you look at some of the senior housing REITs there or medical outpatient REITs, the healthcare REITs are trading at a, kind of at a premium to where the public markets are trading. So sorry, compared to the private market, where the private markets are trading. So I do think it's really asset class dependent today, but you're starting to see some opportunities to take advantage of that arbitrage between the public and private markets. This is a unique time. You can't brush the entire industry with one conclusion. It is asset class by asset class.
How has the higher interest rate environment informed how you deploy equity versus credit? And where are you now in terms of focus on credit versus equity?
Yeah. I think early on in this capital markets reset, so call it end of 22, early 23, we saw a reset of values and credit seemed extremely compelling. You were able to generate higher risk adjusted returns. And based on where you're in the capital stack, it was a compelling opportunity. We did a lot of structured investments. However, it has shifted today. And even as go as far as past, 3 to 6 months, you started seeing the change. Debt availability has become more available than it has historically. We're back to where we were in 2020 and 2021, and which will drive equity volume. But more importantly, credit spreads have tightened to very tight standards and to the point of where they're tighter even than they were prior to the capital markets resets. So you cannot produce the same returns in credit that you could over the past 3 years. So the real time, that's why it's really important that you're pricing both, that you understand what's occurring in equity and debt, because it really does impact how you think about where the best risk-adjusted return is, and it's a yield gain. And so today, I believe equity is more compelling.
And geographically, what are your views on Sunbelt versus gateway cities versus Midwest?
Yeah. Again, you can't take a holistic approach. We're active all over the country and we look at demographic tailwinds, municipality changes, what's occurring with real estate taxes. we went to San Francisco early, and that's really benefited us. We saw the change in the municipality. We saw the movement that was occurring. So we took some significant bets. Probably should have bought more. But and then we look at what's occurring in the Sun Belt and Southeast, and you would scratch your head and say, you know what, probably not the right time to invest. However, if you think about supply change and corporate demand, it really does impact your investment strategy. There's continuing to be corporate demand in the Sun Belt. Can't ignore that. So it's not about ignoring a certain market. It's about when do you enter that market? And are you getting the buy right, especially in these times where there's volatility and markets are moving quickly, right? So if I had mentioned San Francisco to any investor 2 years ago, they would have thought I was crazy. But now it's one of the more bullish markets. Midwest, people are focused on, if I look at multifamily in the Midwest, I believe it was one geography that had outperformance on rent. However, the corporate demand isn't as significant as maybe the Sun Belt or the Southeast. So it's really looking into the holistic picture and trying to figure out, when's the right entry time. And again, we are an IRR driven shop. So your entry really does matter and impacts your underwriting and how you can achieve your total performance. So for us, that is kind of how we approach it.
Speaking of San Francisco, there's a lot of talk about AI and its impact on corporate America. Any house views on whether there's going to be a major impact to office or residential, and any sort of significant AI strides you're making internally in how you operate your business?
We believe AI and data analytics won't replace human judgment, especially in real estate as a tangible asset class. We think it will amplify it. So over the next decade, as we view, the biggest impact should be really in real-time portfolio monitoring and using tenant data to manage operational intensive sectors like healthcare and seniors more effectively. And we're trying to deploy AI to filter deal pipelines so the teams can really utilize data more real time and focus on the more complex, highest conviction opportunities. But for a firm like Artemis that operates in the middle market and in a space where there's more capital and efficiency, and always really heavily relying on that partnership with our global operating partners, relationships will continue to be very crucial. And I think we can't diminish that. But better data and smarter tools will help us do it more quickly and be able to identify risks and opportunities earlier. And so that's how we think about it. And we do think it will impact our industry and change how we invest, but we do think in the end of the day, that experience and judgment will still need to be there.
In addition to your leadership roles at Artemis and your prior firms, you've also sort of dedicated time to PRIA and ULI and the industry at large. What are some of the lessons, and what are some of the leadership lessons you would convey to the audience, and sort of reasons why people should be involved in beyond their firms in the broader industry?
I never did anything intentionally. It really was organically. And I was never looking to gain something from someone. For me, it was always like, how can I learn more? Right? It wasn't, how can I have this person do something for me? It was about, how can I learn from that person's experience? And so for me, it was the experience in different market cycles has really impacted who have been better investors or not. And so as I think about leadership lessons, it's living through cycles. It inherently teaches lessons, which is hard for this generation that is less patient. So for me, it's always been experience and maturity does come over time, and therefore patience. But more importantly, I think something that's really worked well for me is proactivity and empathy. It's really being empathetic to the person's decision, not to be, pass judgment or, but it was more about, how do I be empathetic to that person's situation, decision making? Also, how am I thinking 5 steps ahead? And that's really the inherency of the proactivity. And I say that to our team all the time and say, think ahead, be proactive, anticipate, whether that's supply in the market, that's volatility with your operating partner, volatility with something that's challenging on the asset. Maybe it's the capital markets. We see a change. How is that impacting other parts of our business? we look at today's market, which is inherently there's a lack of transparency and opaqueness, and sectors gone in and out of favor. But really, that if you maintain that experience, maturity, proactivity, and empathy, you can work through the different challenges. And for me, at least, it's always by leading by example. I can't expect others to do things if I'm not doing them myself. And so for me, it's always been like, okay, take the extra time to spend with someone, develop that additional relationship. Who knows where it will lead? Also, just lead with kindness and humility, because the best relationships I have developed in the industry have been through, you know, randomly someone, interacting with someone either on a transaction or just, someone was an intern of mine 20 years ago and now is running a business and remembers how I treated them 20 years ago. I really think that really can't be lost in today's market. That holistic approach is really differentiated.
And any advice for people who are earlier in their career and also have a non-linear path and want to get into real estate and the private equity side of the business?
Don't let other people's narratives define you. And I think that's so important today with social media and just everyone gravitating to one asset class, to one firm, or one approach. If you don't let other people's narrative define you, you can change your own story. I didn't look or sound like a typical Wall Street profile. And for years, I felt like I had to work twice as hard to prove that I deserved the promotions and the success. Eventually, I realized for me, the room needed what I brought and not the other way around. So focusing on performance, preparation, proactivity, and integrity really did impact me in the long run. And so I always try to say, actions speak louder than words. So let your work speak louder than your assumptions.
Anar, before we wrap up, I always like to ask for a personal recommendation, something outside of real estate that's meaningful to you.
So I do outside of real estate. I have a 13-year-old son and a 10-year-old daughter, and they really have allowed me to grow as an individual, teaching me more resilience and patience. Something fun that I'm doing with them currently is reading the books that they're reading in school, which for my son is A Raisin in the Sun, just a classic. And for my daughter, it's Wheat Flour, which is a book focused on immigration and the Japanese experience during World War II and with internment camps and immigration. I do think it's fun to read classics, and we can really take a lot of lessons as I've been reading those books with them to present day and what we're experiencing just in our world. So it really, whether it's teaching my children or my team, it's just reminding ourselves on, history is a pattern recognition. And so, we use that history to really help identify patterns going forward. So I think that's really meaningful. And so it's something that it's important to, teach our younger generation. However, I also really, it's important to give back. And so I think as a family and personally, I try to do as much as I can to pay it forward, whether it's with, my own community, the Indian community, or whether it's women. I try to do what I can to ensure that I'm paying it forward for everyone who has helped me in my 20 plus years career. And so whether it's connecting with people outside of real estate and really learning from others, whether it's different generations or others' perspectives, I really try to focus, whether it's through my time at Spark Youth or with ULI or PRIA or even just other initiatives with even my children's school. I think it's important that I'm continuing to be in touch because I do think that makes a better investor and a better leader.
Well, that's a wonderful note to end things on. Anar, I wanted to thank you for joining us on the Real Estate Forum. We look forward to seeing continued success in your leadership roles at Artemis and the industry at large.
Thank you guys so much. I really had a pleasure, and I hope some of my lessons are helpful to your community. And I'm always available to anyone and reach out. And so please, thanks again for the opportunity. I really appreciate it.
Absolutely. Thank you for listening to the Real Estate Forum, a podcast brought to you by the Paul Milstein Center for Real Estate at Columbia Business School. Be sure to subscribe for more insights from real estate thought leaders, industry professionals, faculty, and the latest research and expertise from the Milstein Center's Research Lab at Columbia Business School. If you've enjoyed the episode, please follow, rate, and share the podcast. You can keep up to date with the Paul Milstein Center for Real Estate at business.columbia.edu/real estate. Thanks again for joining us, and we will see you next time.